everybody's not supposed to be here. Disclaimer.
Yeah, it's on right now.
All right now.
Yeah.
Okay, well, good evening, good evening. Thank you all for coming out. Really appreciate it. And I hate to, get in the middle of the conversation, because that's, anytime we do these seminars, I really, kind of stress the networking, making sure you meet people. That's why I said that a couple minutes ago. I started off in real estate. I will always go to these type of seminars, and they're really, really good. You go to some, they're good. Sometimes they're pitching you stuff, but at every single one, what you want to do is try to meet somebody, because you're like-minded individuals coming to pick up information that's going to hopefully move them forward in life, right? So make sure you continue to network and throughout the night and try to meet everyone, get some refreshments. We're going to get through this information. I want to get you home early. We usually go from 6:30 to 8:30. First 15 minutes is for networking. My presentation is going to be about an hour 15 minutes tonight. And it's going to be on the topic of understanding group investing, right? How many people heard that term in different ways? How many people are, familiar at some level with group investing? Very good. Well, group investing, really, I wanted to make it vague, because in group investing, there's a lot of different ways you can structure a deal, all right? The professional language for it is syndications. But there's other ways to acquire a deal with partners that are not necessarily a syndicated deal. So that's why I wanted to make this kind of a general topic, and I wanted to make it, I said, understanding group investing, all right? Not just group investing, all right? Because I'm not proposing that everybody goes out and starts a group and buys real estate. It's not easy. It's not easy at all. Very difficult. It's very intricate, but can be very profitable if you do it right. So that's up to y'all, But I want to just give you some information if you so choose to do that, or if you see an investment out there that's a group investment and you're considering that, you could at least have some background understanding of how to evaluate the deal, some background understanding to see if that makes any sense for you at this time, all right? So feel free, this is a small, intimate group. Feel free to ask questions. We have a bigger group. I'll say hold the questions to the end. Small, intimate group, go ahead and give me questions as we go through it, because we got more than enough time. So, that being said, my name is Steve Peterson, and I'm the broker and owner of Infinity Investments. This is our office. We've been here since August 2012. The company's been around since November 2009. So we've been around the block. And how many people were in the real estate business in 2009? All right, so we got some veterans. So a little bit of a different climate today than back in 2009, right? But real estate is real estate. Investing is investing. There's principles about investing in real estate, investing in anything that's going to last regardless of what the market is, right? It's more so about the principles. The market's always going to change. So that's why I think if we understand something, a topic, then we have a better chance for success, no matter if the market's going up like it is now, or if it comes down like it was in 2008, 2009, right? And actually, there's more money to be made when the market goes down, right? But you got to be on point with your game plan, because you don't want to get caught, right? A lot of people got caught, like a lot of people are going to get caught again, upside down in a declining market, all right? So I mentioned that about 2009 because that's when I started business. I started business because I was working with investors buying apartments. At that time, if you had cash, the market was great for you, because you turn on the internet, there was deals left and right, right? Now, how many people's out there actively looking for deals, making offers on deals, either for yourself or for a client right now? Victor, I know you're active. Would you say it's easy to find a deal, or it's difficult to find a deal right now?
It's hard.
Very difficult to find a deal. You know what I mean? In 2009, you turn on the internet, it's deals coming at you left and right. All right? So it's just a different time. Now, I started the company, and we focus on, sales like a regular brokerage, but we also do syndications, group investing. All right? And that was a unique niche at the time. And something right now, I'm not doing a lot of syndications because we're kind of at the top of the market. And there's not as much meat on the bone for a deal. Now, the big time syndicators, a lot of these developments you see up and around downtown Oakland, we on Telegraph. So if you go to Telegraph, go left and go right, you will see cranes. When I go to Telegraph, and right over here on my block on 24, if I look left and right, I can see about 6 cranes right now. All right, and just the ones I can see. All those are big syndicated developments. All right. So right now, though, at this point in the market, there's not a lot of meat on the bone, right? But that always changes. So it's a good time to gather some knowledge, because I'll tell you what I did a couple of times in 2011 and 2012 and 13 is found a deal, put 2 or 3 people together, and then invested in the deal, right? Every deal's not a home run, every deal's not a winner. Really got to know what you are doing. I learned a lot of what not to do, a lot of what to do by going through it, right? I also went to 1,000 seminars and classes and stuff like that, and I'm always doing that. Went to the CCIM education, got my CCIM designation, right? But you really learn by getting in the trenches, right? So I want to say that because I'm not just, today is not about getting you guys to go out and put together groups or invest in something I got going. It's really about getting the fundamentals together, right? Getting the fundamentals together, and it might not be time right now. If you come across a great deal in the top, when we're at the top of the market, you still take it down. But it might not be time right now. However, when you get the fundamentals together, you'll be ready when the opportunity presents itself, right? So, what exactly is group investing? Right? I'm just gonna kind of take it from here. It's essentially when 2 or more investors get together to acquire property. They effectively are a group. 2 or more people is a group. Now, the structure of that group can take many different forms, a lot of different forms, right? So, joint venture, tenant in common, general and limited partnerships, limited liability companies, real estate investment trusts, community land trusts, Delaware statutory trusts. The list goes on and on. This is just the tip of the iceberg, right? But essentially, 2 or more people buying real estate, that's a group, right? So when we got that going, now we're in a group. That's why I wanted to make it group investing and not syndication, because me and you, say we go out there and go buy a property together, we're a group, but we're not necessarily a syndicate, right? Syndicates when you really put, a large amount of people, maybe 10 people, 5 people, 20 people together to go acquire, and somebody running it kind of as the manager. The other people are really, really passive. But if us 3 go and buy a property together, we might all be in it, and we're in the trenches together, so to speak, right? But we're still a group, just like the big syndicates who are doing these major deals downtown. The same principles apply, all right? But the structure, as you see, there's a lot of different structures, all right? Now, why invest in a group? Now, there's a couple different reasons, right? A couple different reasons. And I have clients that own a lot of apartment buildings that won't partner with anybody. And then I have clients that's all they do is partner with people, right? So it's different strokes for different folks. You figure it out. But just a couple reasons is, first of all, you're able to buy more than you can buy, yourself. If you can only, even if you got $10 million in the bank, you still got a cap, right? If you go buy a $10 million property, all cash, you ain't buying nothing else next month, right? Because your $10 million is gone. Hypothetically, you can refi and do some other things. But we're all limited to an extent for what we can do by ourselves. We got more people or a team, we can do more, right? Now, you also can limit your liability to only the capital you invest, eliminating mortgage risk and property operational risks. People, when I say that to a lot of people are like, what do you mean only your money? Yeah, because if you go and buy a property, right, by yourself, you're not only putting at risk your cash, that's at risk, but also you have mortgage risk, right? You have debt risk. That means is the deal don't go right, the deal goes south. You not only lose your cash, but you also have damaged credit because the mortgagee could potentially come after you, and you got some liability there, right? So if you invest in a group where you put up cash and you're a limited partner, your only liability is the cash you invest. You don't have to worry about the mortgage risk, or you don't have to worry about the tenant suing you. Tenants sue people, right? Or in California, everybody sues everybody in California, right? So when you invest passively, you don't have that liability, right? Now, also management, okay? Real estate is different than a stock investment in the sense of you got what they call tenants, toilets, and taxes. All right. So a toilet breaks down, that has to be fixed. Now I'm not advocating anybody in here go out and start. If you buy some property, you go fix toilets. I don't. I've been in real estate my whole life. I don't know how to fix toilets. My toilet is in there, been on the blink for a couple of days, right? My toilet's still on the blink. I'm not advocating that. You want to get a good property manager, somebody who knows how to operate a property, right? But you have to deal with it nonetheless, right? You put your money with Merrill Lynch, you don't got to worry about that, right? Whoever runs that company is dealing with their issues. So when you invest with a group and a company or an individual sponsors the group and they're handling all the management, you don't now have to worry about those hassles, right? That's put on the manager, the sponsor of the group. Also, I'd like to say this, is you leverage the strengths of other members in the groups, all right? So if you're kind of an active group, so let's say you four go out and buy a property together, and you say, we all work this thing together. Somebody may have real good accounting experience. Somebody may have excellent credit to get the best possible loan. Somebody may have construction or property management experience. Somebody may, just be a great problem solver, right? So you're able to leverage your strengths and minimize your weaknesses like that, right? And I think the key to all of this is you want to generate passive income, and if you're doing it in a group, you can just leverage yourself a little bit more than you can do it by yourself. Those are the good things. Now, go ahead.
Question for you, Steve. How does crowdfunding, with the FINRA approval, apply to the examples you gave earlier?
And I'm actually going to get into crowdfunding, but let me just hit on that. The question was about crowdfunding and the FINRA approval, essentially allowing financial advisors and the financial markets to roll clients into these type of deals, crowdfunded deals. How many people are familiar with crowdfunding or have heard of crowdfunding? All right.
I've heard
It's I'm not the expert on it, but essentially it's just a way to raise money in very, very small increments. It also opens up investment opportunities to people who are not what's called accredited investors. How many people have heard that term, accredited investors? Basically, you're a millionaire or you're making $200,000 or more in your taxes. There's some other criteria, and yet that's a millionaire not including your personal residence. So in California, that eliminated a lot of people. You own 2 or 3 houses, you're a millionaire in California almost. All right, but once they take away your personal residence, which is I don't agree with that philosophy, because there's equity if you sell it as cash you'll put in your pocket. After the crash, they took away that qualification of accredited investor. Most investments are only available to accredited investors, and that's kind of a double-edged sword. The government set that up a while ago as a protection to protect people who don't, who might be investing their last dollar. What it ended up really being is a restriction. So a lot of the best investments you couldn't invest in unless you were a millionaire, right? So now with the Jobs Act that was created back in the Obama administration, opens it up for everybody to be able to invest, all right? There's some pros and cons and some intricacies within that, but essentially crowdfunding just takes it to another level, because in the past, we could only raise money through personal relationships. You have to have met somebody, develop a relationship with them. You can't put it on Facebook. Now with the crowdfunding sites, you have to go to crowdfunding sites, got to be vetted and approved. You can put your, not just real estate, your business idea, whatever you have, out there to the world, right? You can market it like Charles Schwab, right? So that's kind of the idea. And it definitely hits in real estate for sure. There's a lot of crowdfunding. I'm actually going to give some of the websites that I know of that are, some of the top crowdfunding websites for real estate.
Do they still fall into the category that you showed earlier about the limited liability, you only put up the capital, that type of thing?
Yeah, and it's a lot of different structures because, it kind of depends on the entity, like a limited liability company or LLC. Okay. But yes, the main thing, the key of it is I'm investing my dollars passively. You know what I mean? I'm not investing and then I'm gonna come join the management team and I'm doing the toilets. I'm investing it passively. That was a great question because that's the key. Right? Now here's some of the cons. All right? I'm gonna keep it 100 with y'all. I'm gonna be straight. All right? I'm not gonna be the TV infomercial because there are cons to this. There's some pitfalls, and I've dealt with them myself. Right? So I've dealt with them in seminar world, and I've dealt with them in the real world. All right? First con of investing is that the investment is illiquid in nature. It's not liquid, right? You can't say, man, Merrill Lynch, man, I'm worth whatever they call it now, Charles Schwab, B of A, I need my money tomorrow. I'm in a bind, I need to cash out. Well, you cash out, but it don't happen tomorrow, right? It could take, 90 days, take 100, it could take a year, depending on the structure. And in some structures, it's like, boy, you invested in this group, this is a 5-year understanding. Yes?
Question on that, do you set that at the beginning when you put together this group?
Absolutely.
Clear the area and full
You wanna, so if you're putting together a group, you wanna let people know that, look, it's illiquid in nature, okay? We're investing together, right, for the long term. Or if you're doing a flip, it might be a shorter term, but it's like, look, you can't get your money out till we're done. We're all in the same boat together, right? This is real estate. But isn't that the same thing if you go out and buy a fourplex or 20 units? The difference is you can make that decision on your own if you have your own property. You say, all right, forget it, I'm putting it on the market. You can't do that with a group. It has to be a group decision, right? It's got to be a group decision. So another thing that's a con is that the transfer of individual ownership interest can be complicated. So let's say us four right here, we got an LLC together, right? And so 20 make 100%. We all 20%, right? Then I'm like, I get in the bond, and I realize, it's not liquid. I know the rest of the partners, this deal's going good, everybody don't want to sell, but I need some money real quick. So how can I sell my 20% interest? You can do that. It's just very complicated and complex, right? And again, it's not like just going to the stock market, selling your broker, get it off on me. It's a lot more detail. Denise, good to see you, by the way.
Hi, thank you. Question about that. So let's say you are in a bond, you want to sell your ownership interest. Is it typical that if you are forming a group that is written to whatever rules that you're abiding by, that maybe the group needs to approve? If you buy somebody and then somebody else has to approve. Or what if you're coming into a group? What rules should you be looking out for if you're the person that's stepping in to kind of save somebody else?
Yeah, there's usually a buy and sell clause within the operating agreement. So in the different structures, there'll be different, like if it's a corporate structure, maybe, the bylaws, LLC, it's a operating agreement, different, but in their agreement, there will be buy, sell provisions that talk about if you invest in this, you buy this percentage, you have the ability to sell it, but usually 99.9 times out of 10, the rest of the partners can approve or deny whoever buys it. Also, the rest of the partners are 99.9% of the time, they're gonna have first right of refusal to buy your interest, right? So that's important because, do I have it on here? Dealing with partners can be difficult, very difficult, because you're dealing with people and all the stuff that comes with people, right? You know what I mean? So if somebody gets in a group, somebody's ready to buy interest, and they come in, they're very domineering, they want to control everything, and if they drop out of property, there's a beer can outside, they call you about it. You know what I mean? It may not be the person you want in this group. But that would be up then for the partners to decide. And the partners would have first right of refusal to take. And usually in most partnership situations, I've recently dealt with this twice, where owners of buildings that were about to be sold or were being sold, partners had bought out another partner. Usually a partner wouldn't want to buy out another partner, and usually the person selling is going to go to their partners first. So just buy me out, I'm taking this, buy me out, But everybody's capital situation is different. But the question is somebody going to have to approve it? The partner's going to have to approve it. And that's usually going to be in the operating agreement, and there's a buy-sell provision as part of that operating agreement. That's a good question. So it's some challenges there. Yep.
Now, what about the, say, like you said, all four of us was in, and my 25% I sold to one of the partners. Would that mean that they're a controlling factor now?
So that's a great question. So now they have the majority of interest. However, there's usually going to be there's always going to be a managing member or general partner in the situation. So a managing member or general partner can have less of a percentage than, let's say, you bought the other person's interest, now you 50%. So you have the majority of interest, but it's who's got the management control that really, really goes to how things are gonna be run. Now, you have more leverage, you have more voting power, you have more dollar power, right? So you are gonna increase, and some of the other partners might be like, wait a minute, hold up. Do we really wanna do that? So then what you would say is, okay, then everybody else piece up and we all buy it. If y'all worried about me controlling everything, then y'all put up some money and we all buy that share, and then pro rata we get added to our shares. But you certainly can do it, but it usually goes to, now, most of the time people doing what you just said, they already have the management control. Right? That's usually who buys it, right? So usually, not all the time, but usually that's who usually buys it. So now, not only have management control, but they have a big part, of the ownership, which could be a concern to the other members, which is why they would have to approve for it. So, same thing with all real estate, everything's negotiated, you know what I'm saying? And you have to make sure who you're dealing with. That's the main thing I wanted to put to you guys before we go into some of the meat and potatoes is, hey, there's some benefits of it, and there's some drawbacks of it as well, and that's, y'all be the judge of how you want to do it. But it's very similar to business. You asked a lot of the right questions, and if any of y'all have had business experience where you buy and selling businesses, mergers, acquisitions, stocks, that's where, in this element of real estate kind of comes together and is very familiar or synergistic or similar to like the stock market type deals or business deals, okay, where business owners come in and buy each other out because it's this kind of like structure. It makes sense? So,
Yeah, just.
Sorry about that now. Gotta keep running. So, now, I'm gonna kind of now start getting into some of the nitty gritty. So we went over what was good, we went over what was bad. Now let's get into it. So, group investing is often referred to as syndications. The word group investing and syndication are often interchanged for each other, but a syndicate may be defined as a group of people who form an association to undertake a business transaction. Now, I reference here the expert. I'm not the expert on this. I'm delivering expert information. I've done some deals. But Gene Trowbridge, CCIM, is the expert. And he's got a book. It's called It's a Whole New Business. And he actually updated that book to talk about crowdfunding and the Jobs Act for that very reason. If you are interested in group investing, if you're interested in raising capital and doing large commercial real estate deals, you need to get that book. All right? And go, if you just Google Gene Trowbridge, CCIM, he's going to pop up. And he's a lawyer, but he's also a syndicator, which is very, a good combination to be, right? So he breaks down this definition of syndicate in his book, and I really think, it's been a great book for me. If you want to get serious about this, get that book. So here's just a brief example. So you want to buy a 20-unit apartment building that costs $2 million, but you don't personally have the resources to do so. Therefore, you form a syndicate of investors, let's say 10 investors, to contribute 200 G's each to acquire the property. So 10 investors, 200,000 each, $2 million. Now that's an all-cash situation. A lot of the deals involve a loan. It's tricky when you get a loan, right? Because here's why. Lenders, we all love lenders, don't we? They want everybody who's 20% or more to sign on a loan. They want to see their taxes, they want to see their financials, they want to have them sign off their wife and kids if anything goes wrong. Now, isn't what we just talked about, isn't one of the main benefits of investing in a group that you are not benefiting in the mortgage risk? You don't want the risk of that mortgage, right? So it does get a little bit complicated, but just know this, if you're over 20% ownership interest, a lot of times lenders want to see your information. However, sponsors, people putting together these, the term sponsor, if you hear that, that's somebody who puts the syndication together. Yeah, person?
Do you have to put under your name, or can you put it under something else?
You want to put it under some sort of entity. So let's say you're investing in this group, right, as a passive investor. I highly advise you, when you're doing investments of any kind, it's a professional thing. So put it in the LLC, put it in the trust, put it in something. And it's you know, a little bit of cost and expense to do it, but it's more than more worth it, right? Because you just, you know, now you have a business entity to have a life of its own. You got a little bit of protection for other liabilities, and you're just setting yourself up as a professional. I always recommend that. You don't have to though. You don't have to. A lot of people take the title personally.
Well, when you start an LLC, it hasn't established its own credit line, so would you have to either buy it yourself and transfer ownership, or have you?
Yeah, no, I mean, and the LLC is a good question. The LLC, in any entity, right, has its own, develops its own credit history because it has a tax ID number, right? However, there's always a responsible party for that LLC. And when you get into the commercial real estate loan, so line of credit might be a little bit different from like a mortgage loan in the sense of that mortgage lender wants the responsible party, anybody who has a bigger interest than 20% to then sign on it. There's ways around it. But then let's say if you have that LLC, you've got a line of credit, and you're gonna go out and buy a property under that LLC, you know, the members, as part of your operating agreement, they're not gonna have rights to that, right? You know what I mean? That's because you're probably gonna set that up in your operating agreement to have that restricted from them. They're not gonna have rights to that, and they're not gonna have liability for that. They can if you want to, because anything can be negotiated in your operating agreement. Because that's how where it goes to, what does your operating agreement say? What does it state, right? And you can really, you know, you got to stay within the law, but you can really get creative at that point. So you wouldn't, let's say you're putting a syndication together, you wouldn't necessarily have to start a whole new one. However, it is recommended in that book particularly that you, anytime, each property you go out and do, you set its own LLC up, and it stands on its own. So if you go do property X, you set up a new LLC, property X, then you have some succession and do property Y, new LLC. You can do the same LLC, but it gets complicated, especially when you're raising money. In fact, depending on how you're raising money, you have to set up a new LLC, depending on how you're structuring, just because you don't want a co-mingle fund. But that's a good question.
I think I heard something also, the reason you do them in separate is so they can't pierce the corporate veil and
Right.
access the other assets.
Exactly.
One unit,
Exactly.
one piece of property. They can't go in and attach the other assets.
Okay, so say something goes wrong, right? Do the deal, right? Hey, I'd love to tell y'all every deal works out great. It's all good. That's just not how it is, right? So let's just keep it real here. You also need to cover your downside risk in this business. You know, I know from experience, cover your downside risk. All right, a good way to not cover yourself is to have an LLC go out and do 2 different deals, right? Because then they can, so one deal blows up and the other deal's doing great, right? So an investor would come in, one deal blows up, everybody lost money. You put money in it, you sign them the mortgage, the mortgage company come after you, you stressed out. Now they suing you, and this property over here with a whole different set of investors because it's the same entity, now they coming at you. And they got rights to do that. That's why, another reason why you want to keep it separate. Yep.
That number 10, that's kind of a large group there. Would you recommend that larger group?
Well, it depends. I mean, like with crowdfunding, there's 50 to 100. You know, but there's groups even bigger than that. You're right though. So you want to try to keep the groups smaller as much as you possibly can. But also, there's the realities of the business world. You get out there raising money. There's a lot more people with 200,000 or whatever nominal number than there is, let's say, with 500,000 or a million, right? So you do what you can do. The key is, I think, here's my opinion with it, is what is your plan, right? What is your plan of action? If you say, hey, I want to go do a deal here, a deal there, a deal here, 10, 20 investors, that's going to be tough. Because now you're running a business outside of the business of running a real estate. If you say, look, I'm gonna go do 3 or 4 of these deals a year, right? Then you're gonna be needing to set up a system to deal with these investors. Now, having to set up the system to deal with these investors, now you can handle more, right? So that goes to what is your plan, what are you trying to do, right? And that can help you kind of navigate through that, you know what I mean? Because that, again, a lot of these things you're gonna have to look and say yourselves and see, hey, this works, this doesn't work, you know. And I'm really advising you guys to take the time. That's why I'm doing this in the upmarket. I'm thinking right now might be a good time for everybody to sit and wait and get your ducks in a row, right? Because a couple more interest rate rises, then there'll be some more deals.
Right. Steve, what do you think about mixed-use commercial property and buying businesses?
Yeah.
Do you think that those should be, should those be separate LLCs with the investors?
Yeah.
You see what I mean?
So I'm actually looking at, I'm dealing with a situation like that now in West Oakland where there's a building and then there's a business, and they want to sell both the building and they want to sell the business. Again, I would absolutely say if you're looking to buy both the building and the business, I would absolutely use separate entities, separate situations, separate operating agreements, because they're two separate things. Right? As a landlord, you buy the building, hey, the building might be doing great, that business might be struggling. All right? So you don't want to get in that same situation we just talked about, to where the building's doing great, but the business is doing bad, and now the business brings down the building because it was doing bad. So at least by structuring it differently that way, you can stave off some issues. Now, the flip side of that is financing. Depending on what kind of business you're buying, see if that business occupies more than 51% of the square footage of that property, you might be able to go out, well, depending, you might be able to go out and get SBA financing, right? Now, there's rules with SBA is similar to FHA for commercial, because the rates are low, the loan value is much higher, right? The loan that's guaranteed by the government. So it's for owner-occupied businesses, a business that owns its commercial real estate, at least 51% of the property. So you get really favorable terms if you do that, right? And that's where you kind of got to have that entity. Right. It's got to be the same entity. And
So can you separate it later?
That's a good one.
Right.
See, and this business is real fluid because you can get creative. Now you can separate it later. You just need to be real. You need to be on your toes. You need to be on your toes with that. But,
where I was going with the line of questioning is, if you've got the two entities and you're GP in one or manager in one, and then you've got the business side with different investors, right, that are picking up a piece of it as well. Is it wise to be GP in that one too? You see what I mean? Because you've got the business, right, and you may have different investors than you have for the actual property.
Yeah. Well, I think the question is, first of all, if you have expertise in that business, right? So all business is not all, you know what I'm saying? Every business is different. So, like for instance, if it was something that you had some experience in and you knew that business, then I would say yeah. If not, I would farm that out to somebody who knows it and bring that partner who's who knows what they're doing, and maybe you put it all together and just say, hey, look, I need you to run it. You don't got to put the money in it. We just need you to run it, right?
And just have the operating agreement.
Exactly.
However you want to structure it, right?
Yeah.
Now it's legal,
right? Now, if it's some type of, like, I have a good friend of mine who has and I don't know if he still has it now, but he bought a building and a laundromat, and a very similar thing. And so he was running the line. At first, he was like, I don't really want to run the laundromat. I just want to get the income from the business. But once it's a laundromat, so it's not like running a restaurant, right? So he was able to kind of get in there, and then the cash flow was crazy. So he bought the property at a great price too. So it ended up, working out for him. But you got to, with business, really got to know what you're doing, right? Because that's a different level. Real estate's a lot more stable. Business can change in a minute. Y'all know how that is. We in the Bay Area. We know how it is. When everything's rolling, it's all looking good, right? Everybody know what I mean? But I don't say it's all looking good, because as it's all rolling, everything's more expensive. You know what I mean? Especially here. You talk to somebody in Texas or Ohio, they're like, how much you pay for your mortgage? How much you buy a house for? Because they can buy something for $200,000 and be living fat. Right. $200,000, you ain't getting a condo in East Oakland right now. You're not. Unless you find something I don't know about. If you find it, let me know. We can put something together. Right? But that's just now, a few years ago, you could have got a fourplex for $200,000 and stuff.
That's right.
That's what I'm saying. That things change. So you gotta just be aware of that. Now, raising money, speaking of things changing, raising money for syndications have changed as a result of the Jobs Act of 2012. And I kind of read right through it. The rules of raising money have changed with the Jobs Act of 2012, creating avenues to advertise investment opportunities for small businesses and startups. However, still today, raising money, the best way to raise money is through developing relationships. All right? There's no better way to do it than developing relationships. End of the day, right? Here's a couple ways you do it. Network at real estate seminars, trade shows, events and mixers. I had to run over here. I was a little bit late running over here because I'm the past president for the Associated Real Property Brokers. And they're having a mixer at Rosenblum. So I had to pop in there, say some stuff, and run up over here. And I'm always with them, anything that we're doing, because that's how you meet people, you know. And as a broker, as a syndicator, you gotta be out there trying to pay to meet people. Also, approaching pre-existing business acquaintances. A lot of you may be in business already. So, if you have some success in some business, a lot of people who want to do this part of real estate, this is a different element of real estate. If you've been to my seminars before, I go through real basic fundamentals, how to raise, how to evaluate property. Last month I talked about creative financing strategies. This is the next level. So usually people who are undertaking this are like professional business people. So you might be running another business and say, hey man, why don't you come in with me on this fourplex deal? And usually business people, especially small business people, really understand real estate, at some level, at some basic level, because they have to deal with either they're leasing their property, they own their property, whatever. So they understand business. So pre-existing business relationships, approaching current or past clients, depending on your business. And if you're in real estate, that's a perfect, farm for you. You gotta be careful. But here's my disclosure on being careful. This is business, there's risk in everything. Make sure that you are operating with, honesty and integrity and you're disclosing stuff, right? If you're a real estate licensee, you gotta disclose that. A lot of investors don't want to be real estate licensees because they don't want to have disclosure liability. And I'm saying, well, why do you want to have disclosure liability? Because maybe they're not planning on disclosing everything to somebody, right? Good way to get over on somebody, right? You don't have to disclose on it, right? But if you plan it straight up, it's all good. And you can buy properties with your license, you can make commissions when you buy a property. A lot of the sponsors who put these deals together are brokers or have a lot of brokerage licenses. So when they put a deal together, they get paid a commission and a syndication fee, right? Commission is the commission. Syndication fee is a tip that I get paid for putting all these investors together. Because you take risk, you might as well get paid for it, right? So that's a little bit on that. Now, asking for referrals from clients, attorneys, accountants, wealth managers, financial planners. These are great sources of people. Now, everybody I just mentioned, they're all professionally licensed people. So they're not just gonna throw you something just to be throwing you something. They gotta know that you are an upstanding person, that you have a viable deal, and usually there's something in it for them, and something that we can't, like, if there's a commission, you can't pay commission fees for people, right? And when you're raising money, you can't pay those commissions, but you can return a favor by throwing some business, right? Your accountant throws you a client, well, maybe you should go throw them a couple of clients to do some taxes, right? Reciprocity. So that's the key why I say the best way to raise money is to develop in relationships. That's really the best way of doing business. With the Jobs Act, though, we can go beyond that. And we can do that by engaging a crowdfunding site to market your offer, right? And some of the websites I'll talk about, they've developed relationships with the marketplace, right? They've now done so many deals, developed a track record, that they now have a relationship with the marketplace knows them, right? And this is about a year or so old, so that some of them might have changed, but the key is, even if you're online broadcasting your deal worldwide, develop that relationship with folks, just as if it was, a personal deal.
Yeah, what I found is like no trust.
Yeah, that's right.
And crowdfunding doesn't allow you to do that. I'm just saying, it typically does not do that, because typically what I find,
people dealing with people you like and you trust,
especially dealing in syndication of commercial real estate. Me on the business side, I just stay away from the crowdfunding because you don't know sophistication of the individual. And man, I've been upside down easy.
And that's a good point, because you don't know who you're dealing with. And that's a big part, like what I was saying, the pros and cons of investing. The cons of group investing are, dealing with difficult people. And everybody's not cool, at the end of the day. And what you mentioned is some people got pie in the sky ideas with no plan to substantiate those returns that they're offering. So it can get tricky.
Well, let me clarify what I mean by that. I'm talking the crowdfunding for the Jobs Act, not for accredited investors. The ones where anybody can put money into a deal, that's
right.
What I'm talking about, the unsophisticated investors.
Yeah, so, and what he's saying, because there's two elements of the Job Act. I think it's like Job Act 1 or 2. There's two elements of it. For accredited investors, like we talked about before, people have $1 million net worth or they're making $250 a year. And then there's the one for anyone, right? The challenge with now, like I said, the government set up the accredited investor rule. It's a double-edged sword because they are setting it up saying, hey, we're going to protect people. We don't want people who don't got a lot of money investing money. On the other side, it restricts people. Now, where we are now, what we've seen, like what you're saying, is a lot of when it's, people can put in, $1,000 to $5,000. Now it opens up to unscrupulous people putting together deals and saying, hey, 50 people give me $1,000, we're gonna go out and, do something. Because everybody's not a great entrepreneur. Everybody's not a great sponsor. Right? So that's some of the risk. Where we all, as a marketplace, as a community, need to do is make sure we can flush those deals out, by looking at them and evaluating them. And that's some of it. That's how we deal with that. And that's why developing relationships is always important. You know what I mean? Yeah.
So I don't know which websites you're gonna show, but I know there are like some websites for small business, startup businesses, and they vet the business.
Yeah.
So it's not just any old business that they're putting out there, but they vetted their financials, they vetted their stability plan, they vetted their income generation so far. So are some of these sites that are crowd investing sites, are they structured that way too?
Yeah, and the real estate part of it is a lot different, right? Usually there's the crowdfunding site, the platform. And the platform needs to vet the ideas of the business. And in real estate, they vet it heavy, right? Because they got liability too. Now they're a neutral third party, they're gonna have all kind of waivers and all this type of stuff. But when the market goes south, which it will, at some point, we don't know when. Right. And I'm not being a negative person, I'm just understanding real estate goes up, goes down, goes side, that's what it does. So when it goes down, somebody's gonna lose money, right? And then that's when lawsuits come out. But like what you're saying, the company's going to take their time to vet out these people, right? And it's an old market. I'm sure Morgan Stanley and Bear Stearns and Lehman Brothers. Lehman Brothers was the biggest one that went down. I'm sure they vetted a whole bunch of people. But at the end of the day, right? It happens. So the biggest key is understanding this, right? It's understanding of what we're getting into. All right, now. Here's some of the prospects. And by the way, I'll send this, we're going to send this presentation out. What I've done in the past, I'm trying to step my technology game up. What I've done in the past is sent a sign-up sheet around. Here's the problem with the sign-up sheet. I have everybody write the sign-up sheet. My virtual assistant can only read about half of the emails. So if you want this presentation, please go to my website, infinityinvestments.net, not .com, infinityinvestments.net. Go to subscribe. There's a button that says subscribe. And when you subscribe, we will send you this presentation, right? This is a little bit more streamlined way for me to grab your information. Because last time we did it, I was calling people, asking people if they got it. Because when we sent the email out, about half of the email bounced back. Because people are writing quick because they're trying to pay attention to this. So now, if you go to the website, infinityinvestments.net, click the subscribe button, and we'll send you this presentation. And as a bonus, I'm also going to send you my fundamental to the intro to multifamily and commercial investing, because that's where I go through the breakdown of how to analyze a property, income, expense, all of those things, because that never changed. That never changed, right? This is a little bit more high level, so I'll send that to you, but that never changed. And that's always a great way to be able to vet a deal yourself. Because you don't want to, if you're investing passively, you gotta be the veteran of the deal. You know what I mean? Even though if there's gonna be a crowdfunding site involved or a sponsor involved, you can't be lazy on this. You have to be dialed into the numbers, the real numbers, all right? Real numbers mean the historical numbers. Now, if it's a development deal, there may not be historic numbers, right? Development deals are a lot more risky, but they usually pay off a lot higher too. Now you make some evaluations based on the viability of the project, the builder, the market, so on and so forth. But you always got to vet the deal yourself, is is my key, right? That's how you flush out some of this craziness out there. That's how you justify, the crowdfunding site that's putting it out there, and you justify that deal not by your emotions, but cold hard facts. Make sense? Now, when we're doing this, and I'm gonna talk to you from the lens of if you're going to put out this, you're gonna go put this group together. Who are some of your prospects for syndications? Who are some of the people who they would benefit from investing with you? Now, if you look at it like that, I think you'll have a wider perspective versus you saying, who is my best person to invest with me? Think of who would benefit from investing with me. Think of it that way, because then now you having that mentality of who you're going to talk to will open up the doors. All right? Here's just some ideas who y'all can go after or prospect for. Individuals who have self-directed IRAs. Now, a lot of people have self-directed IRAs. Y'all familiar with that term? Anybody not heard of self-directed IRAs? It's just self-directed IRA is IRA, individual retirement account, where you self-direct, right? You roll it over to a Pensco, Equity Trust, one of these companies where you make the decisions on where the capital is invested. Okay, if it's an IRA with a big fund or institution, you just put the money in, and they make the decisions on how the money gets invested, right? People who've gone out, got some education, got some sophistication, who like to buy real estate and other investments that might not be, that might yield more, will form self-directed IRAs. Now here's the thing, they can't take that cash out till they hit their retirement date. Well, I mean they can, but there's a penalty for it, right? Their whole goal in setting this thing up is to build up that pool towards retirement. So that's a good, doesn't mean they're gonna invest with you just because of that. The deal still has to make sense. But now you're talking to somebody who's would benefit from if you brought them a great deal, right? Also, right. And then they got some tax reasons why they want to keep they have to keep their money invested. So these people are ideal for group investors because their money is still liquid anyway. They can't touch, if they want to touch their money, they got to pay some fees. So they're not trying to touch their money. So if they go on a deal and you say, hey, this is a 5-year commitment, right? They're cool with it usually. Also, people who's conducting 1031 exchange. And we all know what 1031 exchanges are? Just quick, it's a tax deferred exchange. So if you sell one property, you have capital gains, you made a big profit. If you want to defer, not avoid, defer the capital gains, you can do a 1031 exchange. You got 45 days from the time you close that deal to identify the 3 properties, and you got 180 days from the time you close that deal to close on one or all 3 of those properties in order to roll all that gain over into the next property without paying capital gains tax, right? Transfer tax you still have to pay, but not capital gains tax, that's the big one. Now, if I play Monopoly, that's the 4 greenhouses, 1 red hotel. That's what that move is, right? So what happens to these guys is you sell a property, it's time, I just mentioned you, 45 days, 180 days to close. That's a lot of stress. That sounds like a lot of time, that's not a lot of time, especially in a market like this. You sell that property, that clock is ticking. And it's ticking on real days, it's not business days. It's not, if the 45th day is on Christmas, you need to have something in by Christmas. That's just how it is. So, stress. Now, that person gets to day 43, and their deal that they were working on breaks down, and you come to them and say, hey, I'm putting together some investors for this deal. If it makes sense for them, they can roll into it, that might be a perfect person for you. Or just somebody who's selling a property, they've been in the real estate game for a while, they want to be more hands-off. They say, I got this equity, I'm gonna roll it up. I trust you, I like the deal you got. That's a great match, right? So just another source of people you can talk to about this. Now, what we're seeing today, a big part of my brokerage business right now is 1031 exchanges, right? A big part of it. And I'm talking to all my clients about the state of the market. And my whole advice is be careful and be wise about what you're doing. I'm telling that to everybody. And not a lot of brokers, I noticed that not a lot of brokers are saying that. Because brokers just want to slam people in deals, right? But if we want to be around as brokers, I think we ought to give good advice. However, when you sell in a building, I come right to you. When you sell in a building, okay, and you pay taxes, depending on your tax rate, I know they just changed some stuff, so I get into that. That was last month. We hit that last month with the tax reform. But bottom line is, you in California, you're gonna be paying anywhere from like a minimum of 25 up to 35, 40% of your profit in taxes. So, if you can roll that money over to something, even if the market goes down 10, 15%, you're still ahead because you was gonna take that 25 to 40% hit off top, right? So it makes sense for you to buy in this market if you're doing exchange. If you're just coming into the market, you got a pocket full of cash, I'm not saying it don't make sense, I'm saying that you need to be careful about what you're doing and make sure that you're buying for cash flow, right? So that just means that people who are doing 1031 exchanges could be ideal candidates for people in a group investment, right? Now, another group is busy professionals who got capital to invest, but they don't have time. Okay, we're in the Bay Area. We got a lot of these tech guys. You know, tech people is making some good money right now. But you know, they work like crazy, you know? And it's very competitive, so, you know, they gotta be locked in. You know, they don't got time to be on the weekends looking for deals and doing all that. You know, if you out here doing deals, looking for deals, you know it's hard and it takes time. So, a good source of people who can rock with you as an investor and, you know, and it be good for them is people who have high incomes and they're very busy, right? That's a great source of people you can go after, you know? Now, and we're in this type of area where we got a lot of people like that. I grew up in Oakland my whole life, born and raised, East Oakland, went to Oakland High. I bought my property here in April 2012. When I was here in April 2012, half of our block was vacant, you know? This whole neighborhood was different, right? So there's a lot of growth, a lot of development, a lot of gentrification, right? And people from Oakland and born and raised here, you had to deal with violence and crime and open public schools, and now you're out here trying to make a living and everything's expensive, and you're like, oh, all the gentrification going on. Frustrating, right? Here's what it is. If that's you, what you got to start doing is figuring out, well, how do you win in this whole thing? How do you come up? How do you benefit, right? You know, you get mad about something, but if the train is coming at you and you standing in front of it, you're going to get ran over. If you stand on the side, it's going to pass you by. What you got to do is figure out how to hop on that train and make it work to your advantage, you know? And in an area like where we at in the Bay Area, there's a lot of people making big money who don't got time to go do deals, right? And if you have the time and expertise to do some deals, maybe there's some opportunity for you, right? And so that's just the idea of people who might benefit from investing in projects like this. Now also, ambitious investors who want to invest in projects larger than what they can buy themselves. So I know a few people, kind of like what we talked about. There's a gentleman who owns a bunch of property on his own now. You know, very wealthy, very smart, young guy out of San Francisco. But we're talking about doing some stuff together. Because he's just saying, hey man, you got some experience raising capital, I got some cash, I want to do some stuff, I know some people, you know some people, let's come together on this, you know? So there's a lot of people out there. Now, to get to those investors, you might have to do 1 or 2, 3 deals. I forgot. I kept on going, I didn't come back to you.
Yeah, no, it's okay. I was wondering, the 1031 exchange can be possible from, let's see, from another state like Vegas to here?
Yeah, absolutely. Great question.
Yeah.
Yes. So I don't think you can leave the United States. I don't think so, because they want their money. But you can definitely go state to state. And you can sell raw land and you can buy a fourplex. You can sell a fourplex and you can buy a retail property. It has to be like kind, but like kind means real property for real property, right? So it can be Texas to all, and in fact, that's what a lot of California investors are starting to do now. That's what a lot of California investors did in the old market, because you sell a fourplex here, and like for give you an example, I have some clients sold a couple houses in East Oakland. They bought in 2009, under $100,000, right? They sold a couple $100,000. Two properties. They took that money. They bought a 56-unit apartment in the stock. Same state, The concept is simple. Let's just say you had a fourplex in Oakland, you sold, and you go out to Texas, you might be able to buy a 50 unit or a bigger unit with more cash flow. That's why people do it, and you can absolutely do it state to state. It just has to be deed for deed. When you're doing 1031 exchanges, when you do a group, you have to be in like a tenant in common or Delaware statutory trust structure, because when you roll your money into that, you have to have what's called a deeded interest. You cannot just be an LLC participant. You have to have a fractional interest in the deed. So that's an important thing when you're doing a 1031 exchange. It cannot just be, I have 20% of this LLC. It's got to be, I have a 20% deeded interest in this property through this LLC. A little complicated, but that's how it's got to be.
Question is, how many days after we sell the property we have?
45, great question. He asked, how many days do we have after we sell the property in an exchange? You got 45 calendar days from the time you sell to identify. This is what that means. When the money goes from escrow, it goes to what's called qualified intermediary. This is a company like IPX Exchange, like Asset Exchange in San Francisco, Chicago Deferred Exchange. These are qualified intermediaries. So the money don't go to you. It goes from escrow to them. That first day, from that point, you have 45 days to identify, which means you write on a piece of paper, send it, they have a form. But you send it to the qualified intermediary, and past day 45, those are the properties you live with, you riding or dying with, right? Now, you got 180 days, not 181, 180 days from the time you close on the property you sold to close on the replacement property, right? So the new property you buy, by the way, that's called replacement property. That's the proper term for it. The real estate slang, that's called an upleg, but it's called a replacement property.
Identify property means like to give a bid for that property, or?
Well, great question. Here's my advice on that. All right, there's some broker advice on that. If you're gonna identify a property, ideally, you wanna have, beyond that stage, you wanna have a contract of some sort of, right? Now, you get into a point where you're day 44 and you ain't got nothing, you need to have something written down on that paper. And then hope and pray that you can get it done, right? But ideally, you wanna have a contractual obligation to purchase that property so that you can then focus and get it done within 180 days. Because it is tough. It's very tough to get that done. And then, Denise, you have one? I'll come right to you. Denise, you have a question?
Oh, no, yes.
Okay. I did. Okay, good. Thank you.
So you said land, you could do land, you have fourplex, yours.
Yeah.
The dollar amount has to be.
Okay, good question. In the exchange, the dollar amount has to be equal or greater, cannot be less. Well, look, it can be less, but whatever that less is, that's what's called boot. It's called you get in the boot, you gotta pay some taxes, right? So ideally, here's the because we're doing this. Now, we're not doing it just to defer taxes. I want to catch myself. I was gonna say we're doing it to defer taxes. You only sell and do an exchange because you want to improve your portfolio. You want to improve your cash flow. You want to improve your system. You want to get a better property, right? And as a result of doing that, hopefully, there's more cash flow and you don't pay taxes, right? So what you don't want to ideally do is go in and pay taxes because you didn't do it right. So the key to doing that is what's called spend the cash and replace the debt. Whatever loan you had, you also have to replace as well. So let's say you got $1 million property, right? You got a $700,000 loan. Sell it, you got $300,000 of cash, $700,000 of debt. On the next property, you got to buy $1 million worth per down. That can be spread out between up to 3 properties. Right? And actually, you can do more than 3, but it gets complicated. Stick with the 3 property rule just for sake of simplicity. Now, you can spread that amount over a couple of properties, but it has to at least be equal in order for you to not pay any taxes to the property value that you sold. So if you sold $1 million, you can buy exactly $1 million or $1.1 million, and you're good. If you buy $950, you pay a tax on that $50,000. Right? And it can be Again, it's just deed for deed. And let's say you sold $1 million property, you can buy $350,000 properties and you come out good, right? Just that total aggregate amount of what you buy has got to be equal to what you sold. You have to spend the cash and you got to replace the debt, right? Makes sense? Yeah, they want to keep the loan in service too. So that was it's some investors want to get out of debt, and I don't blame them, right? I don't blame them. But the governments and the bank, they tend to be cool with each other. They're like this, you know what I mean? So when the banks are part of all this legislation, they want to make sure they get their piece too. Right? So you got to spend the cash to pay the debt. That's how it goes. So now we'll get a little bit more into crowdfunding. And again, I'm not the expert on this. I'm just touching on this. We talked about it a little bit, but I want to just kind of drive it home. So we talked a little bit about crowdfunding, and here's some actual definitions according to Wikipedia. The practice of funding a project or venture by raising monetary contributions from a large number of people. That could be 5 people, could be 500 people. Large number of people today often performed via internet mediated registries, but the concept has been executed through mail order subscription, benefit events, and other methods for hundreds of years. Crowdfunding has been around. It's just, it became a buzzword when it got attached to the Jobs Act, right? Now, the crowdfunding model is based on 3 types of entities. The project initiator, who proposes the idea or project to be funded. In the business becomes a sponsor. But for crowdfunding language, it's the project initiator. The individuals or groups that support the idea, investors, and the moderating organization, the platform. That platform that goes and then vets the different investors, right? And the crowdfunding model brings all 3 of these partners, all 3 of these parties together today via these internet platforms, right? But understand the concept has been around. With this new legislation, you're now able to go hard on the internet with it, right? And we're seeing anything from mom and pop crazy investing ideas to big corporations raising, tens of millions of dollars for a $100 million project. I mean, you've seen it all, right? So,
hey Steve, have you heard of Buyback the Block?
Yeah, man, that's
I was going to ask you about that. Have you done any digging into it, and you have any perspective on that?
So, you're talking about the Jay Morrison Buyback the Block?
No, there's one specifically called.
A crowdfund.
A crowdfund for gentrification issues in the urban cities across the United States. And they're doing it with commercial business as well.
Interesting. No, that's the first time I just
started.
Really?
Yeah, it's called Buyback the Block. They're running ads on Facebook, Twitter as well.
Buyback the Block.
Buyback the Block. And so I'm going to ask you a little bit more about that.
So now I haven't heard of it, but see the concept. So I've heard of that. So the concept, Rick Ross and them had, they had a song about it. Then, so Jay Morrison, who is a big time, Jay Morrison is a big time YouTube. I don't want to say personality. He's a big YouTube influencer. He's got a lot of experience in commercial property, particularly apartment buildings, also single family home flips. He comes from the streets, the East Coast. He switched his life up, took his street hustle and put it into business. And he's made a lot of money. And he actually was just in Oakland last year on his Buyback the Block initiative. He's been going to hoods across the country talking to people about buying properties in their neighborhoods. Right. So it's kind of, that's why when you said about that, that's what I thought you were talking about. You talking about an actual crowdfunding platform.
This system is actually FINRA certified.
Wow.
Right? And so that's what it is. It's actually a crowdfunding platform, right? However, they give the disclosures, right, about it. But what I'm seeing on there is the initiators, or whatever we want to call them.
Yeah.
They don't. It's not as vetted as it should be. Is what my point.
Well, and that's the thing. And look, with anything like this, in the initial phase,
right?
Mm-hmm. And this is 2012 was kind of all got going. This is first 5-10 years of a segment of an industry, that's the initial phase, right? We're gonna go through this thing, just like the cannabis industry is right now in California, all right? And as real estate brokers, at CCIM, we just had a meeting about this in January, because as brokers, we're trying to get our arms around it. It's a big part of commercial real estate, right? But what the issue is the regulator, there's so many, gray zones, and so many people saying this, so many people saying that. We're in the initial phase, right? 10, 20 years from now, we'll have some of this stuff sorted out, right? But people who take the initial risk, usually the ones who end up with the big paydays. However, there's always gonna be somebody. This is how I go. That's just how I go.
It's the same thing with the ICOs for cryptocurrency.
It's the same thing. It's the same concept.
Scammers out there, but there's some quality stuff.
So the key is, that's why I call this understanding, right? You got a better understanding of it, you can vet some of that stuff. You might, look, I'm on the buy back the block mentality. I'm on this site, let's see what's good. But you're able to look and say, okay, wait a minute. This deal don't look right, right? And some of the people who are on there probably really excited, they're principle based, but they may not have the expertise yet. But they're swinging a bat at least,
Right.
So maybe there needs to be some of us on there who got some experience, do some stuff, and be on there. I love that initiative, so the crowdfunding site is called Buy Back the Block.
Buy Back the Block.
I like it.
And it's specifically focused on us.
I like
Deal
it.
with gentrification.
Yeah. Well, because here's the deal about gentrification, and we're in a hotbed of gentrification right here. No matter what your opinion is on it, right? And being from Oakland, and I've seen this place change dramatically. It ain't all bad. But the frustrating part of it, right? The frustrating part of gentrification is if you lived in an area and gentrifying areas where a neighborhood that was the neighborhood is down economically or depressed economically, all of a sudden is getting this influx of capital from outside investors, right? What ends up happening is those people who've lived there, who've been scarred by, by life and by the system. If you live in Oakland long enough, you've been scarred by the town in some way, right? And then all of a sudden you're looking at, it's so expensive, I can't even live here, I can't even work. It's frustrating. This is your home, you love it, right? And as crazy as this place is, it's home for a lot of us, right? So we here. So the key, that's why I like that buy back the block name, is you've got to be invested. You can't just be, they gentrifying and this and that, blah, 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 blah. You know what I mean? You gotta put some action to it, because this is economics, and we in capitalism. In a capitalist society, capital dictates to almost everything, right? So when money comes in like this, like I said, the train is coming at you. Don't stand in front of the train, right? Let's figure out how we hop on that train, get some tickets to that train, and then bring our friends on that train, right? Because now when I say you walk outside, look to the left, look to the right, you're gonna see 6 cranes. I counted them the other day. When I got to this block, when I bought my piece of this block, it wasn't no cranes. It was a couple of Heron bags on the corner. Right. You know what I mean? Everything was vacant right here. And people was like, you doing business over there, right? You know what I mean? So things have changed. So we just got to participate in that. And that's what group investing can help you to do. Right? So we got to understand it though, because it's not like it's without risk. Anything worth doing usually has risk. Anything worth doing, is usually, a challenge. And I would say, this Uncle Lou, everybody say what's up to Uncle Lou. He is my maintenance man, my uncle, and he handles all my maintenance. We about to go in there and handle some maintenance. We talked about tenant, toilet, and taxes before, right? We got some toilet issues. I ain't dealing with them. I call Uncle Lou. So so I'm sorry about that. But okay, anyway. So just to kind of break down the different elements of the Jobs Act. Okay, by the way, Jobs Act stands for Jumpstart Our Business Startups Act of 2012. It was the Obama administration saying, hey, we gotta. I love Obama. I'm not gonna get political. I love Obama for a lot of different reasons. Didn't agree with everything. I don't agree with my wife and everything she do, but I love her to death, right? I'm not gonna agree with everything somebody does, but I think what the majority of what Obama did. I love him because he did what he said he was going to do. But he didn't even run on like an economic platform. He didn't say, I'm about to come in here and create all these economic opportunities. He got into a desperate situation. When Obama came to office in 2008, I remember I stopped watching a bunch of the stock market shows because the stock market was like 6,000 and people was like crying, blood was on the streets, and you just had to stop. I was like, I don't need to hear none of this negativity. I'm going to sell some deals, right? But at that time, it was tough. So they start doing everything they can, some good, some not so good, right? But the whole goal is we can't let the system crash. Because if the system crashes, everything's going to crash. Let's just be honest. You know, so a lot of people didn't like the bailout, but what was he going to do? You know what I mean? What was he going to do? So a big part of this was government saying, hey, look, you know what? Small business actually drives a lot of our economy. See, that's the thing that a lot of us don't understand is that small business individual, I think we employ more people than big corporations. So we just don't realize the power that we have because we're so sporadic and spread out. The big corps, what they have figured out is how to harness, human productivity, right? As a small business owner myself, that's a challenge. Right. Of course. Because what AIG was like, yeah, help me out, right? You know what I mean? They got the love, right? There was a bunch of people who did not get that love. Yeah. And they went down. Because you're right about that. So what this job act is set up to do is kickstart small business, right? And there's two parts of it. Title 2, which is for accredited investors. We already talked about that. And it allows mass media advertising. Because even with accredited investors before, there were some restrictions on mass media, right? That's why the Charles Schwabs of the world kind of had that game on lock. And they weren't so happy about this. But I think they've also figured out how to get their piece of action too. Of course, that's just how it is. Title 3 for non-accredited investors and allows internet advertising, right? And I put a reference. There's an article. It's an older article, but this is like when it was first getting going. It's referenced at fundable.com, and I'll send this out to you guys. And it's I don't even know how to say that. Telophilic Mag, December 11, 2013. So that's a great article that really breaks this down and goes into what it is. And so go on there to the website, and we'll get this out to you, and you can hit that up. But that was the crux of what the Job Act and crowdfunding was all about. Like I said before, crowdfunding been around forever. The term got popular with the Jobs Act, right?
With Obama's campaign too.
They put it on blast.
Yeah, right? He raised all his money through crowdfunding. And you see that right? Okay, so that's a great point. Right? Obama outraised, and I don't know if he broke the record of history, but I know he did.
Yeah, at the time he did. I know he defeated both his people that he was running against in terms of raising money. Obviously, he won the election too, but he grossly defeated them in terms of raising money because he didn't just go to people with deep pockets. He busted it down to people give him $5, $20, and people was down for the cause.
Chip in.
Right? And that concept, he's sitting here saying, wait a minute, that concept is how I got in the office. Yeah. Can't that concept work for business? Yeah. And it can, but there's like we talked about, there's some challenges, right? That's what we gotta understand. But it absolutely can't work, and that's why it was all put together. Now, some websites, some real estate websites. Now, just for our talk, we talk real estate. There's a bunch of other ones. So on the next time I do this, I'm gonna put that one, Buy Back the Block.
I'll send you a link.
Send that to me, man. Because I'm on that. But here's just a couple of them. Now, they're usually for bigger deals. Now, here's what I seen. Here's my analysis of crowdfunding in real estate. Man, it's like the big boys hop on everything first.
Right.
So now when you go on a lot of these websites, it's the big time investors. However, I'm not mad at them. It's business, man. It's capitalism. Whether you're Florida against it, if you playing football and you're in a basketball uniform, everybody else got shoulder pads on. It's not a good look. You know what I mean? You're gonna get ran over. You know what I mean? You gotta put the pads on of the game you playing, right? And if you're in the hoop game and you got your helmet on, they not letting you on the court. So we in United States, we gotta learn how to buy the weave out here with some principles and integrity. Now, so that's why I say I'm not upset with the big syndicators who hopped on this stuff first. If you go to a lot of these websites, you're gonna see big deals. Because a lot of these deals are available to people who are not accredited investors as well. So I know, like for instance, patch of the land, you can get on there and invest. You don't have to be, you know, accredited investor. It allows mom and pop to play ball in these big deals. You know what I mean? So I'm not mad at that. I just like, man, what about the small business guys? So we got to get small business syndicators and people who put together deals. We got to get more aggressive about going after this stuff. So here's just a few websites. Crowd Street, thanks, appreciate it. Crowd Street, Realty Shares, Patch of Land, Groundbreaker, Crowd Baron, iShares. I know iShares, there were some, they had some issues. But again, everybody gonna have some issues. Business, you do business, you're not gonna not have issues. Release.
So, first thing, I actually got to meet the CEO of Patch Plan, in a program that I was.
Cause he's local, right?
No, he's in LA, but he does a lot of deals here. Program you told me about.
Yeah. Ross?
Yeah. But one of the things, cause he came and gave us talk, and one of the things he did mention was that, you know, as they got bigger, their deals were getting bigger. So just, you know.
Yep.
There's a sweet spot. You know,
Yeah.
there's people out there doing their individual flipping things, getting harder to do out
Yeah.
there. And there's people doing like, you know, Trump pushing or whatever we
Yeah.
But there is a sweet spot in
Yep.
the middle. So how do we take advantage of that? Because what it is information, and
Yeah.
information is not being readily available on these type of websites. So,
Yeah.
so how do we get the information out there?
Well, I think, okay, good question. I think a lot of this, when we're down, we get into the meat and potatoes of doing deals. A lot of this is finding the deals. Okay, so here's what I mean by that. If you can source a property that's a deal, when I say deal, I mean some kind of discount, some kind of creative financing, some point of situation, or so it's right by the BART station. There's something of value there. It's not just something that's on MLS. Now, like what you said, there's people doing the individual house flips, there's people doing a big time deal. A lot of those deals are going to be in the middle somewhere, right? So not too big, but not too small, right? So we got to be good practitioners. We got to get real good on finding these opportunities, because when you find the opportunities, now the big money, the little money, you know, you're able to approach people and they will listen and talk to you. You know, and so a lot of my experience has been through where I've broken through and made some connections was bringing, and I've pitched so many investors deals when they wouldn't even call me, and all of a sudden I pitch them one and they call me right back, right? And then all of a sudden I'm talking to somebody I never talked before, and an hour later it was just like I was sitting in house business school soaking up this knowledge, right? So in order for us to kind of break through to these levels in the game, kind of source deals.
Well, so for me, just so that everybody know, I am a real estate broker. So for me, it's kind of the opposite thing where I have deals. I don't have investors.
Yeah, okay.
So getting the deal, the potential deal, and I know every investor is different. Every investor, some may want to be more involved, some just want to put their money somewhere. You know, it's all different. But getting the information out, finding people who have the capital, who may be interested, is the hardest part. So again, how do you get the information out there for those deals that, you know, would be great for people that have a certain amount of cash, not too much, but not too little.
Yeah. Okay, so let me see if I'm hearing you right. So you're saying, okay, say I got a deal, you got deals, right? Mm-hmm. And now you're trying to figure out how to get the info about the deal out to the sweet spot of investors who
how to match
benefit.
the money with the deal. If I have a deal, and how to match the investors to the deal if you have cash.
So a big part of this kind of goes back to the beginning of what I was saying is really, it goes to developing your network, developing your relationships. Because here's the thing, and then look, you got a network, say you got a database, right? And you have a deal, right? Now, within that framework of the deal, it depends. If you got to list it, if you got it under contract, you got to have some sort of like protection of the deal, right? Before you start marketing it to the world. But you really want to have a database. Starts with that database, and you build up that network. Now, you can always bring it to one of these. That's what I'm talking about, the sites, because say you got that deal, right, and it makes sense, and there's a market for it, and you can put it on one of these sites, because that's what they're looking for. The cash, the more of what I see today is more cash and less deals. There's a ton of 1031 exchange investors right now. I got a few of them. And I'm cold calling, I'm sending out mailers, I'm sending out email blasts, I'm networking, I'm talking to everybody I know, because it's hard to find it. So if you got that, right, now you got to go and approach these folks. Let's say you put a deal on, let's just pick one, crowd banner, right? Say you got a deal, throw on a crowd banner. Now there's some costs associated with doing this, right? You got to pay the source, right? So again, you got to pay the source. You know, if you have it, it might be a good investment. Now you got to push it. They're going to push it. But now you got to push it. You always got to, if you're the sponsor, you're the entrepreneur putting this together, you got to be the engine to make it happen. Okay? So it starts with your network. You can utilize crowdfunding. You want to utilize email marketing. So what all of us need to start doing, if we're not doing this already, is developing a list. And people who got cash you can invest. So when you come across that deal, you send them an email about the deal, and you call them about the deal. You set up a meeting. You set up a meetup. A big part of when I start doing these meetups, right, is I want to get to meet people. I don't pitch deals at the meetups, right? What I do is give real information to people that they can use in their business, and in hopes to develop a relationship with them in their business. So over the years, I've done a lot of business that way, right? So that's an element of creating that connection. Now, I've been doing this over several years. So there's a network of people. So if I've got a deal, like we were saying, we can email that deal out, we can blast that deal out, we can put it on this crowdfunding website. Here's the reality. Just like any other business. You gotta hunt it down, you gotta find it. It's not, and in real estate, it's more imperfect than anything else. All right, like a stock market business, it's a lot easier, it seems like, to connect those dots. It's a lot more challenging. Because what happens to me is when I come across a deal, and I got people who got cash, it seems like every time I find a deal, the first time I pitch it, I'm like, oh, that's this, and I don't like that neighborhood, I don't like that unit mix, an apartment building, unit mix, 2-bedroom, 3-bedroom, 1-bedroom. So you gotta have a long list of people you call, because if you might have 10 people on there, and you think it's a great deal for everybody, and you call them all up, you email them up, all of them like the deal, and then it's like, So you gotta develop and expand that network, right? And there's no like surefire one way to get it done. But the key is, through time and with consistency, to develop your network, develop relationships, and then leverage technology, right? Leverage technology. So these are just some sites where you can leverage the technology, but you gotta still at the crux of it, at the core of it, you still gotta be building up, right? And I'm telling you, like Denise, deals is the king right now. If you got deals, there's money hunting for deals, money fighting over deals, money putting other people in headlocks over deals right now. You know, because that's what now it'll flip again. In 2009, it was nothing but deals, and I was like, "Where's the money? Where's the money? Where all that?" And people was just spooked. I remember calling people. I would look on Foreclosure Radar, Sequence Foreclosure, just call people like, "Man, there's a fourplex in West Oakland right now. We can take it down for $180,000. There's a fourplex in East Oakland right now for $150,000." And people was like, I don't know about that neighborhood.
They're still mad too. They are still mad.
Man, to this day.
I be mad.
So what I'm saying is, the point is, it's an imperfect business.
Yeah.
Right. But you got to be consistent about it, and you got to identify your spots where you can work it, and then be consistent about it. And raising money is probably the more difficult thing, the most difficult thing in business. But if you can learn how to do it, it's one of the most powerful things in business, right? So Trump's got a lot of money, but when he does deals, and I don't know if he's still doing deals, I don't know how that works, but he's built up a lot of deals because however he did the deals, because he put these deals together and had a reputation. He was able to say, "Hey, I found this deal over here. I'm about to go develop it," and people would throw money in. I read his first book, Art of the Deal. I read all the Trump books, which is why I didn't want him to win the election, because he's a very powerful, domineering guy. But not to get into politics, because a lot of people, everybody has their opinion. But one thing about Trump, like him or don't like him, when he was a deal maker. You know what I'm saying? So what he would do is he would find these deals he would find a situation that was like all bad. And what he got good at is putting the money together and then making the project successful. And he got to a point where anything he did almost touched the goal, you know, because he was, you know, he would be able to source a deal and put that money together. And people, once you get to that point, the money's coming, what you got? You know what I mean? Where he ran into trouble is he went against his own rules, is he, you know, he guaranteed a lot of loans, market went, you know, South late 80s, early 90s, and he had some troubles, you know what I mean? Like, you know, he's the president now, but he had some troubles there. Because so much money was coming at him. He got some trouble now, right? But he had so much money coming at him, right? He had so much success that he was like, all right, you know, I need to put this in motion. I need to go find this and then just maybe get the deals outside of what his sweet spot was. So the point being is that
licensing his brand.
And that's what he did really well. He licensed his brand, you know what I mean? And so, you know, he could put his name on the building. And he can just not put up no money, no nothing, and people would come and pay him because capital's always looking for deals, it's always looking for a home. And as markets ebb and flow, like where we are right now, it's very difficult to find a quality deal. So if you can source that, right, that's 90% of the battle. Then it becomes the understanding of how to structure it, how to put it together, you know, what site's best, what method is best. And my thing is, I'm always like, with my agents in the business, I'm saying you can't, if you're broke marketing yourself, you can't depend on just one way, right? When I came up, my broker, when I first got into business, look, you're gonna sit down here, you're gonna cold call all day, right? That's what I did, I got good at that. So that's kind of like my, you know, my core of how I find deals. But I've learned how to expand on that. Learn how to do some email marketing, learn how to do some digital Facebook marketing, you know, networking, doing events. I've, you know, expanded it and adapted, right? So you can't just rely on one way of finding deals or one way of finding investors. You got to cast a wider net. That's the key, and understand what you're dealing with. And these are just some sites that are out there. Like, I'm sure there's, and these are the bigger sites, right? So they're gonna have bigger deals. But I'm sure there's a gang of them out there that, you know, we don't even know about, right? And if you search and look, there's always going to be some opportunity. And like I like, thank you for bringing that one up and buy back the block, you know? So if you're at all concerned about that, and for me, you know, I work in both worlds, you know, I'm, you know, being born and raised here, and then I'm the president of KRAP, California Association of Real Estate Brokers, the Black Brokers Group. We have our national organization has an initiative for 2 million additional black homeowners the next 5 years. So we're really on a big push to get black folks into homes. My value add to the group is, let's not just focus on homes, let's get folks into investment properties. Buy your home, then go buy your duplex, then go buy your apartment building. Let's build on that. So my grandmother moved here from the South. So in Oakland, before World War II, was a predominantly white town, East Oakland. So Castlemont was predominantly white high school. In World War II, that changed because a lot of blacks came from the South to Oakland and Richmond in the Bay Area because the jobs were here, right? Opportunity was here. It was getting up out of the South, right? So my whole block where I'm from in Brookfield was most people from, you know, Louisiana, Arkansas, Mississippi, you know what I mean, that Texas, a little bit, mainly Louisiana. Most of our block used to be from Louisiana. My big mama, my grandmother, she owns her house free and clear, right? So what I've been able to see, just from even before I got into real estate, was the importance of her having that house, right? Our neighborhood has changed dramatically, you know what I mean? But our family's there. We ain't going nowhere, you know what I mean? She bought her house, she put it in a trust, you know, set it up for good, for bad. We're a part of that block. So real estate ownership is a key part of everyone to be, you know, ingrained in their communities. Now, I also, you know, I'm heavily in the commercial and investment business. So I understand business and economics. What I see in that respect is a lot of our community and underserved people don't understand business and economics. Thus, that's why I do these seminars, like in West Oakland here, is to try to teach and preach that. You know, because I could easily do the seminar at the country club or at Scott's in Jack London, and it might actually be a little bit more profitable for me dollar-wise, but there's a mission and there's a vision, you know, of educating people to buy back the blocks to invest. Because what happens here, capital is going to dictate everything. Whether we like it or not, that's just where we at. Right? So let's figure out how to make it work for ourselves. When they had Mandela on lockdown in the apartheid days, he studied apartheid backwards and forward. He figured out how the whole system worked. So when he got out, he was able to get in there and come to power, right? He didn't just say, I don't like this. He said, I don't like this, but I need to understand this. You know what I mean? I need to understand how these folks are thinking in order to kind of move forward and move my people forward. So he had a way of deducting how he could make an impact and make an influence. And so my thought on this is, look, let's use business and investing, particularly real estate, as a method for people to not get bounced out of their neighborhoods, right? Because the biggest thing that's bouncing you out of your neighborhood is housing. It's housing.
Housing, right.
It's housing.
Right.
So if you can get into a business where you benefit from housing, now you can stave off you and your family having to get bounced out of here, and maybe you can help some other people. When that train is coming at you, don't stand in front of it. Don't just get out the way. But let's put the group together and let's all get on that train. Right? And we here too. Right? Now another key to this, I want to make sure to point this out. There's a brother by the name of Ray Carlisle on the board for Bridge Housing. He started NID, one of the founders of NID, which is a housing counseling program and organization. And what he said at one of our events was critical. So NARAB, National Association of Real Estate Brokers, we were fundamental group that passed all the fair housing laws. So the Rumford Act, we was people that was championing that cause in Washington, everywhere. So that's what we do, right? And what he was saying is, look, we fought for people to be able to live wherever they want to live. Do you know in this country there were what's called deed restriction that says blacks, anybody not white cannot buy this property. That's what's called a deed restriction. If you look up a property, and I've seen this with my own eyes, it kind of tripped me out, in East Oakland, that says blacks and goes a whole lot of list of anybody who wasn't white could not own in that place, right? So here's what I'm trying to say. In America, everybody has the right to live wherever they want to live and move to wherever they want to. They are willing and able to live. That's the right. We at NARAB, we fought for that right. Right? So when people come to your neighborhood, it's not wise to be mad and angry at them and things are changing and just kind of fight and have all this negativity. You know what I mean? It is frustrating. Take that frustration and channel that into positive action and participate, compete at a high level. Because anybody can live wherever they want to live in this country. And NARAB, we fought for that right. Now, what we're saying is, let's not get eliminated out of our areas. Let's not get pushed out of our areas. Let's stand, let's fight, let's invest. And I think that cuts across the whole board, you know. We say that message, you know, for black folks, but that's for everyone, white folks included. You know, that's us as a country, you know, and that's the country we live in. Like I say, we're in a capitalist country. That's where we are, for better or for worse. And there's some great opportunity. There's a whole laundry list of people fighting to be in this country. My wife's from Ethiopia, you know, and her whole family, they all came over here, you know. And there's a lot of people from different parts of the world who are fighting to be here. They would give their life to be here in this country, right? A lot of us was born and raised here, you know. And being from East Oakland, being from Brookfield, the thing that hurts me a lot is when people from that area be some of the main people talking bad about that area. You know, main people when I had a fourplex for 180 in West Oakland, let's hop on this. Man, I ain't going to the west, I ain't messing with that. I had a guy, I've sold a building, kid you not, 81 units on MacArthur, to an investor who I've sold a bunch of buildings to this day. I pitched to a guy who was a part of the NAACP at that time. I'm thinking this is I knew it was a great deal. It was 2009, 81 units for 3.7. I knew. I said, no, we're gonna buy this, it's gonna win. And so I pitched it to every black investor I knew. And there was people who was like, yeah, I will hop on some guy. There was a guy who I knew had some money, and I pitched him a deal. You know, he said, I don't want to deal with that N-word stuff.
That what? Oh, shit.
Yeah. Mm-hmm. This was somebody from the NAACP. Wow. What that was, that's how it is. still in the town. High speed action. If you live on Facebook, high speed in the town. A little bit of action. Oh, yes, a little bit of action. Wow. Man. Oh, the
Maybe I'm not comfortable by this window.
I know.
You got some action. Never a dull moment. Something got hit. Something got hit. We heard something get hit.
I know, I'm part of the street.
How many was it?
The cars down there crashed. They secured the perimeter.
Okay, so that's what we heard, the car crash.
And car crashed down there, and it was a high speed. It is.
They were chasing.
They hopped out. They're looking.
Oh, dude, yeah. Once I heard that boom and I saw that first light coming, I was like, oh, it's
See, it's never a dull moment on 24th Telegraph. Well, look, it's kind of going like right to what we're talking about. You know, what I mean, it's investing in ourselves, investing in our areas. Right? It's critical, right?
Two things, Steve. One, what I find with real estate, the reason I like real estate, is you don't have as many moving parts as you do on the business side. Right. I've been on the tech side since '98.
Okay.
So that's one. But two, what's coming? And I'm not sure if everybody's heard about what's happening, but with automation, artificial intelligence, machine learning, minimum 40% of white collar jobs are going to be wiped out in the next 3 years. Okay, that's the beginning. That's the beginning. Blue collar, gone. All that. Right? It's so sick that even the engineers that code is being automated. Right? So the reason I'm bringing that up is it's going to impact real estate clearly because it's going to impact jobs. Right? And it's going to be devastating for gentrification. It's great to talk about the opportunities of the upside, right? But what's coming down the pike with this technology, it's going to be brutal. Brutal. This is why you see, Zuckerberg and the co-founder and Theo and the mayor in Stockton talking about paying a living $500 a month or whatever a living wage. Because they're automating us out of jobs.
Right. Well, and here you go. That's a great point. That's a great point.
Right.
So, but here's the thing. Here's my counter to that point.
Right.
They're automating you out of jobs. They can't automate you out of opportunity.
That's right. That's right.
Again, this is America. It's the land of opportunity. It ain't the land of jobs.
Right.
So we this whole idea of a job, go to work, that's only a couple hundred years old.
But is this why so they keep saying that the market's gonna bust in 2020? And it's related to all these folks with the jobs now that are gonna be upside down.
Well, it's a couple things. One, the bankers are going to run the game. They always run the game because they own the money supply. They own the Federal Reserve, right? So they're going to, as you guys hear about cryptocurrency, right? People think they're moving away from the Rothschild central bankers. No, it's all the same game. They even told us last year that they were going to do it. Well, why do I say that? I co-founded the cybersecurity business in 01. The underlying code of blockchain is cryptography. And Israel and the US created it in World War I. So when people think you're getting into this cryptocurrency, that's exactly what they said they were going to do with one currency world order. Right? So what I'm saying is what's coming, and it's actually here right now, is you're going to see a lot of turmoil. Global. But in particular, the US is going to be hit hard. Right? And so, you're right. Land is land. Right? There's only so much land. And this is why you see in terms of the tax code some of the aggressiveness Trump did, because he's trying to make everybody make the major corporations landowners and everybody else debt slaves in terms of renters and everything else.
And that's the key why, as independent people, you know what I mean, we've got to figure out our way through this. You know what I mean?
Right.
And you can't people are conditioned to go to school, get a good job, play right, do that, right?
Right.
And like my point is that's a new idea. That's not a sustainable idea.
Right.
That's not sustainable. Like Social Security is not sustainable. right? Pension funds is not sustainable. We've got to take into our own hands our lives, our retirements, and what happens to us. And you cannot rely on a government, an institution, a company. Right. We've got to do it.
Right.
That's right.
The shell game that Wall Street plays that we've seen every cycle, right? Where they get complicated and run game on us, right? To go in and fix a problem, right? It only puts the government in debt and puts it on our back. But the coal piece is Silicon Valley is the same beast.
Yeah.
The venture capitalists are just money managers for limited partners, which are a lot of pension funds,
right,
including capitalists. And so I see it on the inside, the games that are run, the amount of money that just flow. Most of these startups are not profitable.
Yeah, true.
You got to ask
they don't even make money, they don't have a revenue source.
Well, they're getting the money from limited partners, which are pension funds.
Right.
Right? So, you know, people that have their 401ks that are self-directed, even like I said, CalPERS, where you got, you know, government employee money, you know, they take a percentage of their assets and put it at risk. Don't get me wrong, but they sign a non-disclosure agreement with these general partner venture capitalists. They can't talk about losses.
Right.
Right? So they're playing a damn shell game with retirement. I also, you know, jacking up the real estate prices. Why? Because everybody's making a rush to San Francisco for the high wages. Yeah. Right? So it's a process, and pretty much, you know, the Warren Buffetts of the world and those type of cats are the ones that really take advantage of it.
Well, yeah, right. I mean, it's like that's very similar with almost any industry or anything. It's people at the top will win. You know,
just manage the risk. My point is the shell game. Somebody's going to get stuck with this high price.
No, and here's the deal. Here's the deal.
Yeah.
That happens all the time, though.
Right.
It's no different from 2007. It's no different from .com. It's no different from Tax Reform Act. It happens all the time. It's just different how it plays out, right? We're in 2018. That's different than 1998 or different than 1986 or the 70s. But what is true in the market is greed and fear usually run the market.
Yeah.
And what we got to do is use knowledge, wisdom, and understanding. Right? Understand this, guys. There's more opportunity when stuff hit the fan.
Right. Now, what I don't know, being an economist and being a technologist, these jobs ain't coming back. No. Okay? Right. These corporations, you know, the job is just over broke because you're at will anyway.
Yeah,
right? And you see it right now. All those corporate, you know, subsidies that were given to the corporations to bring that money from offshore to land, they didn't put it in wages. What are they doing? Buying back stock, buying companies. Yeah. When you do the M&As, what is that doing? Eliminating jobs from using technology. Right? So I'm not saying, you know, we shouldn't be in real estate because I'm in. I'm just saying I don't know
the right way.
Well, I'm just saying we're at a different point because you touched on something. You talked about, you know, businesses, small businesses are the engine. It's always been the engine. However, we're at a different point in our advancement as a society here in the United States in particular because technology's taken over. Right? Before, when we had these dips, you still had jobs, even though it would take a while to get back into it. Yeah. This is eliminated, and this is the first time. Well, and this is the first time it's hitting white collar MBAs, you know, degreed up folk. Yeah. Right? And I just don't know what that's going to look like. Right. So yes, you're right. Opportunity with that risk.
Big opportunity.
Mm-hmm. I just think it's important to know that there are always shifts in terms of labor and what that looks like. Like you're saying, this is the first time that it's hitting white collar jobs, but white collar jobs have only been around for a very short time.
And that's my point.
Well, I'm just saying, we never had technology eliminating jobs. We had.
I'm just saying.
What I'm saying at this scale, guys.
At this scale. No, the Industrial Revolution eliminated a lot of jobs, but it also created a lot of jobs. So we don't know what it's going to look like on the other side, so it's scary. But I think it's important to know that as long as there are human beings on the planet, they'll figure it out.
Well, yeah, I mean, and here's the thing about all that. Because of technology, right? You as the individual can do more. You can compete with corporations. You know what I mean? Think about that for a minute. So we know that shifts happen. Right? These things happen. So the key is, like gentrification, you talk about gentrification, this happens. So the key is understanding it and figuring out your way through it, right? It ain't gonna be easy, right? There's gonna be winners, there's gonna be losers, but you can't sit on the sidelines and say, what I would just say, I know what time have we got? I'm gonna wrap it up on time. Are we 8 more? Okay, so we're 8, right around that. We can be here all day. Look around. Look around real quick. All right? It's kind of my vision for this, right? Get us all in a room. Let's talk about some high level. This is high level stuff. Right? This is not patty cake real estate, right? Right. It's not. Right? Right here in this area, this is a highly gentrified area. Got some action outside. You know, clearly. Right? And that's like, yeah, people say, oh, you know, Oakland's changed. Yes, it is changed. That's why I'm here, and that's why I'm preaching and teaching this message to you all in hopes that we can go out and spread, so that we can be ready for the shift, because that's when you make all the money.
That's it, right?
If you do it right, right? And what I think you make a great point is we can. And real estate, the last couple hundred years have been very tied to jobs, because that's been the economy. Right. But what did they, when Mary was about to give birth, and it was out in Nazareth, or you know, going towards Nazareth, Bethlehem, okay, what did that shop owner was dealing with 100% occupants, or the innkeeper. He didn't have no vacancies, right? That's how long commercial real estate been around. Longer than that.
Oh, we're still under the
Longer than that. You know what I'm saying? You know, here's that's, and that was, so the market must have been rolling pretty good. You know what I'm saying? So here's the key, guys. This is a big opportunity. Love the engagement. See, I sometimes love doing the smaller meetings, because then we can get into this. You know what I mean? It's hard to do that when you got 30, 40 people in the room, and it's great, because this is what we need. And it's not like, you know, I'm done with the presentation. It's not, you know, just like, for instance, group investment. That's the topic we're talking about, right? But it's the idea of taking your intellectual capital and being productive with it. And in capitalism, what I've seen, my assessment is the most productive people, individual groups, most efficient people, individuals and groups win and move forward, okay? And then for us that have been underserved, we've got to figure out how to use all this technology to help us to be more productive and efficient, and we can do it, right? We got to be smart about it, but we got to know that there's some pitfalls. So I don't want to make this just all Pollyanna. I told you about the cons of this. There's some cons of this stuff, right? You know, I've experienced pros, I've experienced cons. You know what I mean? And I want to just share that with y'all. And so, just wrapping up, let's make sure we stay connected. Hit up our website. You know, we will send these. I'll send you this one, and I'll send you our intro, because the intro really hits on how to analyze. See, if you don't analyze deals, that's like the blocking and tackling, right? If you don't do that part, a lot of the stuff that we're talking about really doesn't apply. So hit us up, and then if you got something like, please, can you like send me that, text me that, yeah. And if you got something of value it gave us, we have the meetup group. If you're not, I know a lot of people here are members of the meetup. If you're not, join Oakland Investment Real Estate. That's our meetup. Okay. So please share your ideas, share your thoughts, and let's buy back our blocks. That's a great message. Let's go buy back the blocks. So thank you very much. I really appreciate you all. We still got some wines and crackers. Continue to network. Thank you. Let me go just outside and see what's going on real quick.